Grimes from Market Life, and welcome to the free video for January 16th, 2020. So the trade we're talking about today is a short trade in the stock market. And you can do this with any index that I have SPY up. You could look at the Qs, you could look at the Russell, you could look at futures. I think a lot of people look at the SPY, so that's why I have this here. And I want to think about this very quickly, three different ways. I want to think about, first of all, when you get into the trade, how you put the trade on, and when you get out of the trade. Okay, so when you put the trade on, a lot of money has been lost trying to short stocks, especially on the daily chart, and especially in this market, which has done nothing but go up. And just for the record, I think it's very likely that we're going to go up for many, many months. But what we're looking at is the possibility of a trade that's kind of in between the cracks. So this tells you something about trade management. We're not talking about something where you get short and you take your profits months later. This is likely to be a very short-term 1 to maybe 3-day trade. So when you get in, I think you can save yourself a lot of trouble if you either don't think about shorting until you notice the market is down a lot intraday. That's one way to do it. Another way to do it is to look at the low 2 days back and set an alert there. So you're always, that would be the one we were looking at today. If you're looking tomorrow, then you're looking at the low of the next day. So you're looking here. You're not even thinking about a short until you take out that low on good momentum. And then you look to implement your short. How are you going to put it on? Well, you could short shares. You could do a put spread. I would not simply buy a put because you're taking on a kind of double-sided risk. You're going to be buying when volatility's already popped. And then if the market does go up, not only are you going to lose on direction, but you're going to lose on cratering volatility. So buying a put is not the way to do it. And similarly, buying a volatility product is also not really the way to do it because you still get that kind of punch in the face. If you're wrong two different ways. So really like the idea of thinking about a short, but only if the market is weak. Look 2 days back at the low for the trigger and implement with a directional strategy, maybe in shares, maybe in futures, maybe via put spread, and then you're going to be looking to take profits. I would take partial profits into any weak close, and I would assume that any short you have on is probably going to be good for a maximum of 3 days, and you may even need to look at doing something the next day. So it's a little bit early for this, but just wanted to get us thinking about it, and you can save yourself a lot of trouble if you don't even think about a short without the trigger. So that's all I have for you today. I'll see you back tomorrow. If this video is helpful, give us a like on the video, subscribe to the YouTube channel, tell everybody you know, and go check out my work at marketlife.com. Thank you very much.